Going over IRS Form 8936, Qualified Plug-in Electric Drive Motor Vehicle Credit. This tax credit had a couple of updates because of the passing of the Inflation Reduction Act, and there are some changes that we should discuss before getting into the nuts and bolts of this tax form. So taxpayers can claim a tentative tax credit on either the business side if they use the vehicle for business use or for personal use of the vehicle. This tax form has been updated to allow taxpayers to take tax credits for qualified plug-in electric drive motor vehicles, qualified two-wheel plug-in electric vehicles that were placed into service in 2022 or later, and then new clean vehicles that were placed into service after 2022. So the first thing that we should do is probably define what qualified vehicles fit each of those categories. So a qualified plug-in electric drive motor vehicle is a new vehicle with at least 4 wheels that was placed into service before 2023 that is propelled to a significant extent by an electric motor, drawing electricity from a battery with a capacity of at least 4 kilowatt hours, and the battery is capable of being recharged from an external energy source. It's manufactured primarily for use on public streets, roads, and highways, and has a gross vehicle weight of less than 14,000 pounds and meets certain additional certification and use requirements that I'll discuss in just a moment. A qualified two-wheel electric plug-in vehicle is a new vehicle acquired before 2022 that's capable of achieving speeds of 45 miles an hour or greater, is propelled by an electric motor from a battery that has a capacity of at least 2.5 kilowatt hours and can be charged from an external source. It's manufactured primarily for use on public streets, roads, and highways, has a gross vehicle weight of less than 14,000 pounds, and meets these certain additional requirements. So the certification requirements, that is a requirement for manufacturers and for car dealerships to be able to provide taxpayers with the appropriate documentation and paperwork so that they can claim their tax credit on Form 8936. As the owner, you must own the vehicle outright. If you lease the vehicle, then only the person or company that you're leasing the vehicle from can take the tax credit. You cannot. You have to have placed the vehicle into service during the tax year. The original use of the vehicle, you have to be the original primary owner. You use the vehicle primarily in the United States. And for vehicles that were purchased after August 16th of 2022, the final assembly of the vehicle must occur within North America. So there are also certification requirements for what a new clean vehicle is. And then we can discuss briefly a qualified fuel cell motor vehicle, because you can use this tax form to claim that tax credit that used to be claimed under IRS Form 8910. So a new vehicle is a vehicle with at least 4 wheels, propelled by an electric motor with at least 7 kilowatt hours, primarily for use on public streets, roads, and highways, has a gross vehicle weight of less than 14,000 pounds, had a final assembly in North America, has a manufacturer's suggested retail price of less than $55,000 or $80,000 for a van, SUV, or pickup truck, and then meets certain requirements. A qualified fuel cell motor vehicle is one that's propelled by power from one or more cells that convert chemical energy into electricity by combining oxygen with hydrogen fuel, known as a fuel cell. Manufactured for use on public streets, roads, and highways, final assembly in North America, same manufacturer's retail price, and meets the requirements. The requirements of these vehicles is that in addition to the ownership and usage requirements previously addressed, the seller or the car dealer must provide a report to you as the taxpayer that gives you all the information you need to claim the tax credit. So you should receive a report that has your name and taxpayer identification number, the vehicle identification number or VIN, verification that you were the original purchaser, and the maximum new clean vehicle credit allowable for the vehicle. So, depending on when you put the vehicle into use, there can be different levels of the credit that you can take, and we'll get into that momentarily as we go through this form. There are 3 parts to this form. Part 1 will calculate the tentative credit. In Part 2, we'll calculate the credit for the business use of the vehicle. And then in Part 3, we'll calculate the credit for the personal use of the vehicle. So let's go to the top of the form. We're going to fill this out on behalf of our hero, John Doe. And he has one vehicle. It's a Tesla that he placed into service in 2023. So even though this is for a 2022 tax return, we're just going to pretend that this was in use. Sorry, we'll pretend that it was placed into use in 2022. Except it's not going to be a Tesla. It's going to be a okay. And then the vehicle identification number, it's a 17-digit combination of letters or numbers. You can find that on in a lot of different places in the vehicle. You can find it on the vehicle itself. You can find it on the title, the registration. Usually your proof of insurance will also have it. So, and then we're going to enter the date that the vehicle was placed into service. So let's just imagine that we place this Toyota into service on September 30th, 2022. So this is not a two-wheel vehicle. Basically, for line 3, there's a little known rule called the transition rule. So if you qualify based on the transition rule, which was buying a vehicle after 2021 but before August 16th of 2022, if you had a binding agreement or a purchase contract in place, then you can treat that vehicle as if it was in service on or before August 15th, 2022. This is the day before the Inflation Reduction Act took effect. So there might be a situation where your tax credit is calculated based on rules that existed before the Inflation Reduction Act. We're going to disregard that situation in this scenario, since we purchased the vehicle September 30th, 2022. In line 4A, we're going we know that this is not a two-wheeled vehicle. You would enter the cost of the vehicle if it was a two-wheeled vehicle. You're going to enter the maximum credit allowed for this vehicle. So the IRS has a website that shows all of the different vehicle credits. Oh, and you know what? I need to change this model. I'm going to call this, because the Toyota Camrys are not on the IRS's list of tax credits. So but the 2022 Nexus NX plug-in hybrid is, and this is available for a maximum tax credit of $7,500. So for vehicles that you've purchased in 2023, you should be able to obtain the maximum credit amount from the dealer. So the dealers are responsible for reporting to the IRS. Then if the IRS has a difference of opinion, they will issue notification to the dealership that they need to change the amount of credit that they're notifying their customers to use. So the phase out percentage basically is 100% for almost all electric vehicles. However, because one of the rules before the Inflation Reduction Act had to do with the amount of cars that electric car manufacturers produced, and there was an end to a credit after the first 200,000 cars were produced. So that impacted Toyota, GM, and Tesla. All the way up until 2023, the IRS was no longer allowing tax credits for Teslas and GMs because they had gone well over their 200,000 car maximum credit threshold. But the Inflation Reduction Act took that away, so there's kind of a period of time, a kind of limbo for the second half of 2022 that some taxpayers need to pay attention to. So for Toyotas, if you had purchased this vehicle on October 1st, 2022 through December 31st of 2022, this phase out percentage would be 50%. For Teslas and GMs that were purchased before 2022 or before 2023, the phase out is 0%, so you will get zero tax credit. However, for this car, this period of time, it's a 100% credit. So you multiply line 4A by 4B, and we are eligible to go after $7,500 of tax credit. So in this case, John Doe used his car half for business and half for personal use. So we'll talk about what that looks like. But if you only purchased this a vehicle for personal use, then you would skip part 2 and you would go to part 3 to calculate any tax credit you might get for the personal use part. Conversely, if you purchase a vehicle only for business use, then you're going to complete part 2 and then you're going to end right here. So just keep that in mind. We're going to do this kind of 50-50. So we're in line in part 2, which I'm completing right now. We're going to enter 50%. So in our article, we kind of draw this out a little bit more. When you're trying to calculate business or investment use versus personal use, the IRS determines this by the amount of miles that you drive in a current year. And then you have to allocate that mileage to business use or to personal use. So for example, if John Doe drives his 2022 Lexus, we'll just say that when he bought it at the end of September, he was able to drive it for 10,000 miles between September and the end of the tax year. 5,000 miles was personal use and 5,000 miles was business use. So a common question is, what about commuting miles? I'm driving to work, so doesn't that count as business use? The IRS answer to that question is absolutely not. Commuting is the taxpayer's personal responsibility. So if you drive 10 miles to your office every day, that 10 miles counts as personal use, not as business use. However, once you're at the office, if you're driving to a third location, like you're a salesperson making a sales call, that would be considered business use. If you work primarily out of a home office and this is your primary place of work, and you can verify that to the IRS, then you can drive your vehicle to any business associated place, and that would automatically constitute business use. So for simplification of this purpose, 50% business use. So now we're going to go through and we're going to calculate the business part of this. So 50% of 7,500 is 3,750. If you took a Section 179 expense deduction, then you would back that out here. However, if the vehicle has at least 4 wheels, you're going to leave all of these lines blank and go directly to line 11. So we're leaving these blank because John Doe's vehicle is a 4-wheel vehicle, but you would, if you expensed anything under Section 179, you would claim that deduction probably on IRS Form 4562, which is the depreciation and amortization tax form. So you would take that deduction, you would put it into here, and then you would subtract that from the credit, because as the IRS is pretty consistent in its guidance, you cannot use the same expense for a tax credit and then a deduction elsewhere. So you have to allocate that expense to exactly one tax benefit. So if that's already been deducted as a Section 179 expense, which basically is accelerated depreciation, you can expense a whole lot more personal property under Section 179 in a current tax year, take that tax deduction. Otherwise, you would be looking to depreciate that over multiple years. So generally for vehicles, it's, I think, 7 years. I always look up depreciation because that's something that I choose not to memorize. So you would subtract that out, and then you would multiply the remaining amount by 10%. So for a 2-wheel vehicle, you can take 10% of the allowable credit, and then you have to up to a maximum of $2,500. So that's the maximum credit per 2-wheeled vehicle. We skipped all of that, and we're going to drop down the 3,750 from above. Now you'll see that there have been 2 columns for all of this section. If you had 2 vehicles that you put into use during the tax year, then you would be entering the information for 2 different vehicles in 2 different columns. If you needed more columns because you put 3 or 4 or 8 vehicles into use, then you would use as many forms 8936 as possible, and then when you get down to line 12, you would enter the consolidated amount for all lines 11 across all columns. So in this case, we only have one number that we're dropping down. That's the 3,750. In line 13, this would be if you were a shareholder in an S corporation, or if you were a partner, then you might receive a K1 from either your partnership or an S corporation with a qualified plug-in electric drive motor vehicle credit that is being passed down to you from that pass-through entity. So if you're a shareholder in an S corporation, you would find that in box 13 of your form, Schedule K1 with a code P. And then if you're a partner, you would find that on your K1 box 15 with the code P. So in this case, John Doe, we'll just say that he received $1,000 of this tax credit. So $4,750 is his total tax credit. He would report this amount on IRS Form 3800. That's a general business credit, Part 3, line 1Y. Now, if you're a partnership or an S corporation that's completing this tax form and you only have business use, you're going to stop. You're going to report this amount on Schedule K. Obviously, partnerships and S corporations don't have a personal use component, so you don't need to go any further. If you are an individual and you've put in less than 100% up here, then odds are likely that you're going to have a remaining amount that you're going to calculate a personal tax credit on. So if you skip part 2, you would enter the line 4C amount. If you completed part 2, we're going to subtract line 6 from line 4C. So let's see what that means. That means the $7,500 total credit that we had, we're going to subtract out the $3,750 that we took as the business credit, and that basically gives us $3,750 here. Okay, so if you have a two-wheeled vehicle, then you would go through line 16 and 17. You basically would calculate the maximum credit as you did for the business use. You multiply the line 15 amount by 10%, and you can take a maximum credit of up to $2,500. So since we have a four-wheel vehicle, we're simply going to drop down the $3,750 from above, and then we're going to consolidate all of our columns into line 19. And again, if you had multiple forms that you were completing, then you would enter the total of all of those forms. Now you're going to enter the amount from your IRS Form 1040, your 1040 SR, or your 1040 NR, line 18. This is basically your tax with, there's a couple of additional taxes. There's the premium tax credit, and then there's the AMT in addition to your taxable income. So you would enter that line number, and let's just say that that amount is okay. So I will back up to line 18 for a moment because it did not apply to our situation, but for vehicles that you place into service in 2023 or later, there is a modified adjusted gross income, or MAGI, limitation worksheet. So this is a common term. MAGI for tax purposes means taking your adjusted gross income and then making certain modifications based on the IRS instructions. So basically in this version, you're backing, or you're re-adding certain adjustments that you excluded from income. For example, income from Puerto Rico, foreign income that you might have been able to have exempt from taxation or exclude from your taxable income. All of those get added back in. And this is what's known as an income limitation that's been imposed by the Inflation Reduction Act. So if you did need to do that, the form instructions and our article contain a copy of this line 18 MAGI limitation worksheet. Does not apply to our situation. Our vehicle was placed into service in 2022, so we don't need to follow that guideline. So in line 21, we're going to enter personal credits from your Form 1040. So these are mostly credits from Schedule 3, lines 1 through 4, plus lines 6D, 6E, and 6L, as well as the residential energy credit from IRS Form 5695, specifically line 30. So we break all of the details of those tax credits out in our article. But let's just imagine that he took $5,000 of those combined credits. So if your personal credits exceed the amount of your tax liability, then you can't claim this because this is a non-refundable tax credit. Unfortunately, you can't carry it over and you can't carry it back. So any unused version of the tax credit cannot be claimed. So fortunately, we can claim the entirety of this tax credit. So because this $15,000 is less than or more than the $3,750, we can claim the full $3,750. However, let's just imagine that this was $2,000 and you were only able to claim $2,000 of a tax credit. That reduces your current year tax liability all the way down to zero, but as a non-refundable tax credit, it cannot reduce your personal tax liability below zero. And with the additional $1,750, that's lost forever. So there's not a whole lot that you can do other than engaging in tax planning to maximize the amount of tax credit that you're using. But unfortunately, you can't do that after the tax year has passed. So that's how we calculate the personal use part of this credit. That credit then gets reported on Schedule 3, line 6F. That's all we have for this video. You can read about more detail on this tax credit and specifically how it interacts with other tax credits, how to complete this form. We break down a lot of these details in our article, which you can find the link to it in our show notes, or you can simply go to teachmepersonalfinance.com, type in IRS Form 8936 in the search bar, and you should see our article. If you like our articles, please subscribe to our newsletter. And if you like our videos, please subscribe to our YouTube channel. If you have any questions or comments, please post them in the comments section. Thank you very much and have a great day.